This is the Alhambra Investments Weekly Market Pulse. Joe Calhoun is here, and we're going to review the report that he writes every week, the Weekly Pulse. Joe, there were a couple of things. Number one, you talked about how much of today's quote unquote market and financial news is just noise. And I'm curious from your standpoint, how much of that news blocks out reality?
Well, I just think that the vast majority of things that people pay attention to just don't make any difference. Uh, we were just talking about it. There's a great example this morning. We got the market up, I don't know, 300 points or something like that on the Dow, 40 points on the S&P because Jerome Powell got renominated as Fed chairman. Now, if you'd asked me a week ago, I would have said that if Lael Brainerd gets appointed, then the market will go up because they'll think that she's going to be more of a dove. And instead, it didn't freaking matter. One of them got, it's just the uncertainty of not knowing who it was going to be. Now that's over with, so the market can go up. It doesn't mean anything. And I think the vast majority of what passes for news is just noise. I think that you have to pay attention to certain things, but the vast majority of it, all you have to do is watch the market. The market tells you whether it's important or not. And mostly what you got to watch is bond market. You got to watch commodity markets. You got to watch, gold, for instance. But most of it is just noise, Bob.
Well, that kind of brings me to the second thing I wanted you to respond to. This has gotten to be an incredibly speculative market. And there are companies out there that are trading either with no assets or on unrealistic earnings. Tesla was one of the things you mentioned. Give me your opinion on all that.
Well, I've been doing this a long time, over 30 years. And so I've been through some quote unquote bubbles. I'm not a big fan of the word bubble. Bubbles, stock prices, all these things make perfect sense and right up to the point that they don't. There's usually some reason why these things are moving as they are. It's just that people take them to an extreme that doesn't make any sense. That happened in 1999. I mean, look, there was no doubt that the impact of the internet was going to be huge. But we didn't really know how. So people, since they didn't know how it was going to be this big thing, they just bet on everything. And so I've been through a number of these things, but I got to tell you, what's going on today is way beyond anything I've ever experienced. We're seeing companies with no revenue. Hell, Rivian, $150 billion market cap at one point last week. They haven't sold a car yet, for God's sakes. Tesla, if you added up all these EV company market caps, which I haven't done because, quite frankly, I'm not that interested. I don't know which one of these things is going to last. I think the vast majority of them are going to end up being a complete bust. But anyway, if you add them all up, they're way more than the traditional auto companies like Volkswagen or Daimler or whatever. It's like they think that because electric, it's like people are saying, all these companies are going to make electric vehicles. Everybody on the planet is going to drive an electric vehicle. And oh, by the way, we're going to double the number of people who have cars or something. I don't, it doesn't make any sense. If Tesla were to grow into its market cap, I think most of the other auto companies on the planet have to go out of business. It's like they think they're going to capture everything. Now, I know the argument. The argument is, well, they're not just going to sell cars. They're going to sell insurance. They're going to sell all these other things, and Elon Musk and yada, yada, yada. Look, I don't know. Musk is a very smart guy. And look, you know what? I'll give Elon Musk credit. This is a guy who drove his company, Tesla, to the verge of bankruptcy, trying to get these cars out the door at the beginning. The guy slept on the factory floor. Give him credit, man. He got it done. And I think we didn't know at the time how close to bankruptcy they were at one point. But I love the guy. I think he's great. And I like that he's very, pokes the bear, so to speak, and talking to the SEC or whoever it happens to be. So I like all that. But the stock valuation is absurd. And it's not just there. It's in the cryptocurrencies. It's in NFTs. This Bored Ape Yacht Club thing in the NFT world is just absurd. There's no utility there. There's nothing. There's no there. As what was the lady's name? Kale was her last name. She said that about Oakland, California. She said there's no there. Well, same thing here. There's nothing here that's tangible. Nothing. No utility to these things. And so really all they are is just a vehicle for speculation. And we've got a ton of it. I've lamented this somewhat before. We've talked about this a little bit before. I ranted a little bit about gambling. I think that we're making a big mistake with the degree of gambling that we're allowing in our society, and this is just part of it. So yeah, it is really kind of crazy, Bob. I used that in the piece to talk about the S&P 500, because the speculation is not just in things that don't have revenue. It's not just in the mystical world of NFTs and crypto. It's also in real companies, and some of the real companies in the S&P 500. The index has been distorted to a degree where I don't think it's really investable anymore.
Well, and for anybody who's watching, if you go to Joe's written piece, he's got a whole list in there of how few companies make up the largest bulk of the S&P 500. So I'll put a link in the description down below. But with all this speculation, Joe, I mean, this just keeps butting heads with the prudent person rule that's been around since 1830. I mean, where did prudence go?
Not where, I don't know where Prudence is. I don't know. She's left the building. Prudence is gone. Dear Prudence. Listen, I think people don't understand sometimes what our job really is. Look, we're investment advisors, and we have this fiduciary responsibility, which we take really seriously. And I'm not sure. People seem to think that it's our job to make money no matter what the conditions are. Our job is to make you money, but that's not it. It's to make you money within the context of your risk tolerance and your risk capacity. You can't just go out there and speculate on a bunch of stuff. I can't buy, look, just to take an example, there's no way I could ever justify buying an NFT for a client. No way. I can't do it. I can't even justify buying Bitcoin for a client because there's no way to analyze this thing, because there is no cash flow. There is no investment property of Bitcoin. For people out there who say Bitcoin is a currency, I got news for you. Currency, if the currency is itself your means of speculation, it's not a currency because nobody's going to spend it. Anyway, I think that people don't understand with this fiduciary rule, this prudent person rule. Look, we have to invest in a way that is commensurate with our clients' risk tolerance and risk capacity. We can't just go and say, we're going to buy this because we think it's going to go up. We can't buy stuff just on momentum and say, well, this is going up, so we're going to buy it and hope it keeps going up. We have to have a legitimate investment case to make. And you can't make that investment case in a large parts of the market today. It's not, there's no way you can look at Tesla and say, this is a good investment. It may be a great speculation, but it doesn't mean I can buy it because I'm not a speculator. My clients are not speculators. My clients are investors. If our clients, most of whom are either near retirement or in retirement, if they take a big loss, it's not a minor thing. It's not like, oh, well, I've got time, I'll make this up. For a retired person who takes a big hit in the market, that can end up ruining their entire retirement. So we have to be careful. We have to be prudent. I don't think most people in this business or most investors understand that idea. They all think that they're going to buy this thing. It's going to go up a bunch. I know it's speculation. I know that I'm speculating, but I'm going to get out before everybody else. Look, everybody thinks that, but it's not going to happen. It's not the way this works. Something comes along and blindsides you, you could be down. And some of these, listen, one of the things I learned a long time ago, I'll relate this to something we do internally. Our stock picking method is called value, quality, and momentum. We consider momentum as part of a bigger picture that we use when we pick stocks, but we don't use price momentum. We use earnings momentum. We do that because I learned a long, long time ago that if you're in a stock that has enormous expectations, but not a lot of earnings or none, and there's a disappointment of some kind, these stocks don't just go down gently. There's an old saying on Wall Street that stocks take the elevator up, take the escalator up and the elevator down. I will tell you, if you're in a stock like a Rivian or something like that, and it has a big disappointment, it's not going down in the elevator. It's going to be like somebody dove off the top of the building. You're going to be down 50% before the market opens, and you get a chance to push the sell button. So we can't afford to do things like that, and we won't. To me, I think it's very hard to justify, even for instance, what I talked about in the piece. It's hard for me to justify from an investment viewpoint buying the S&P 500 because, as you said, it's so concentrated now. Seven companies represent 27, almost 28% of the index. Some of those are really good companies. But if you look at the history of the S&P 500, what's in the top 10 today ain't going to be there tomorrow. Something's going to replace it. It goes in cycles. Now, I will say there's one company that keeps popping up. If you look back to the last several decades, Microsoft is a beast. And we own it. We've owned it for a long, long time. You go back to the 2000 top 10, it's in there. 2010, it's in there. 2020, it's in there. That company, for whatever reason, just continues to kill it. But if you look at the rest of the top 10 in the S&P 500, it's a huge turnover from 2000. Only 4 stocks from the top 10 from 2000 are still in the index. Actually, I take that back. Only one, Microsoft. If you look at 2010, there's 4 left in there from 2010, just 10 years ago. So 6 of the top 10 from 2010 are gone. Now, it doesn't mean they're gone completely, but they're not in the top of the index anymore. I can't justify putting a concentrated investment like that in most of our clients for their main equity exposure. I can't do it. And by the way, I said in the piece too, there are ways to participate in this market and still be prudent. Look, you got to look at the S&P 500, look at the growth portion and look at the value portion. The problem here is obviously on the growth side. It's even more concentrated than the S&P 500 index itself. Anyway, look, I don't know where all this comes out. I know that, speculation like this, speculative periods like this are often don't end well. And I don't think this one will be any different.
Last thing today, we had 3 positive reports, better than expected: retail sales, industrial production, and housing market index. Was that really that big a deal?
Well, no, not really. I mean, look, this is the expectation in the market, is that the economy is going to reaccelerate in the fourth quarter here in the post-Delta period. Now, look, I don't know. We'll see if that continues. We do see an uptick in cases recently. I don't think we've seen much of an uptick in hospitalizations and certainly not in deaths. But we're seeing another surge in Europe. Austria, Germany, and a number of other countries are experiencing surges in cases again. So we may not be done with this. Maybe this is, you get a short burst here and then it goes back to fading again. I don't know. But that news that we're seeing some better than expected data, and that's not surprising at all.